Hello and welcome to Insurance Business TV for our final Professional Risks Power Panel of the year. We're going to focus on how AI, data and regulation are reshaping professional risks. We've gathered our experts. Genevieve Mathews is Client Director with WTW Finex. Nick Beswick is Head of Professional Indemnity in Australia and New Zealand for Newline Australia Insurance. And instead of Omnisure's Sjoerd van der Meer, we're welcoming Omnisure's Principal Risk Advisor, Austin Rosier. Well, thanks everyone for coming along. Let's start with you, Genevieve. Looking back over 2025, which emerging risk, AI in advice and underwriting, or data privacy exposures, or regulatory enforcement has most impacted the PI conversation, do you think, the conversations you're having with your clients, and how did it change your work?
Yes. So I feel like a shift this year has been how data and privacy risk move to the center of conversation. So because breaches have stayed high and regulators have raised the bar, there's more scrutiny, bigger penalties, and a sharp focus on accountability. So that's really changed the dialogue from professional negligence to governance and resilience. We're finding underwriters are now asking deeper questions about how firms manage data and respond to incidences, and that's shaping coverage and pricing. AI keeps coming up too, but mainly as a disclosure issue, where it's used and how it's controlled. Right now, it's still sitting as silent AI, much like silent cyber used to be within a PI. So for me, this shift isn't just about negotiating cover anymore. It's about leading meaningful conversations around governance and making policies clear so clients feel more confident that they're fully protected, or at least aware where their risks lie.
And Nick, turning to you, which emerging risk has been impacting your conversations the most this year?
I'm seeing AI continuing to be topical. I think we all sort of expect that the expanding use of AI will deliver more efficient processes, workflows, and improved management reporting. But I think there's still some uncertainty around how AI will impact day-to-day activities and other more complex issues, such as potential breach of copyright and patent laws. From the point of view of delivering professional services, I think underwriters should be aware that AI will be increasingly used by their insureds as a tool of trade. I don't think insurers will have a problem with that, provided that any work or research released or used in a client report derived from AI will be subject to the client's usual risk management checks and balances, to ensure the accuracy and the appropriateness of that advice given. And insurers should be conscious that this issue is increasingly on the minds of underwriters and be able to demonstrate that they do in fact have appropriate means in place to manage the use of AI within their organisation and the provision of their professional services.
And Austin, turning to you, which emerging risk have you been keeping an eye on and has been impacting your conversations the most?
Yeah, I mean, I would obviously echo the comments from Genevieve and Nick around AI, certainly being a buzzword. I think we're yet to see the full flow through of that from an underwriting standpoint. Certainly, it's not something that's popping up in your standard question sets. And I think because it's been such a buzzword, we've actually had to have conversations with clients as to whether or not what they're doing is AI or they're just marketing it as AI. And certainly from a risk standpoint along the IT front, from a software standpoint, we've had to have a lot of conversations with our clients around, hey, don't tell us what you're marketing this as, but tell us how this is actually operating, what this is actually doing. And I think, again, the biggest standpoint from an AI use is understandably that privacy and copyright issue. I think a lot of those issues are yet to be known. Certainly we've had conversations internally and we've set processes and procedures and policies for our staff around how they can use AI, only using it within our protected framework, things like that. This is something that every business is going to have to contend with, and understandably is going to have significant ramifications upon the insurance industry in due time. I think probably an emerging risk that hasn't been touched on though, and probably a bit of a more unusual one to think about, is obviously the way that the market has shifted in the last sort of 12 to 18 months. Significant premium reductions. Like in some instances, like the D&C market, we've seen free falling premiums that are down to 15, 20% of what they were 18 months, 2 years ago. And obviously, the risk there is we've come out of a really hard market. Have we too rapidly entered a soft market? And we've got to have really vulnerable and open conversations with our clients around, hey, don't always take the maximum savings available to you, but look at the insurers that are going to pay out, look at the insurers that have stability, and look at the insurers that are going to be able to partner with your business into the long term, because it's a very real risk if you have an insurer that you've placed a premium with who can no longer pay that or who doesn't have the financial means to do so. It's a very significant issue for businesses to be mindful of.
Yeah, listening to your answers there's a lot of insurance complexity here and a lot of blurry lines. Austin, sticking with you, how do you draw the line in your own head between PI, cyber, and management liability, or is that just not possible?
Yeah, look, I think it's a great question. And I think we're really fortunate that the way we as a business approach insurance is on a whole account basis. So I look after every line of business for an individual client, be that motor, property to financial lines, of course. And I find for us, it makes it easier because we are placing all the policies together, right? So I'm mindful of what's in one and not in another. But it's obviously a really plausible reality that one singular claim event might trigger multiple policies. And I think the way that we often try and distinguish that, and certainly the ways that we have conversations with clients around it, is by thinking about it as an original sin. Kind of, if we work our way backwards, go where did things go wrong first and try and work out where that might sit in the first instance. But it's absolutely something to be mindful of. And I think something that insurers still haven't quite got right, particularly on things like, say, cyber crime, that might fall under management liability wordings or cyber wordings or both. And insurers still don't quite know how to fully reconcile those facts.
I like your original sin analogy, but we better not delve into that too much. Genevieve, turning to you, how do you distinguish between these blurry lines?
It's definitely a tricky one, especially when technology is sitting across all three. Pretty much echo what Austin said. So don't really have much to add, but I 100% agree. It's going back to the core purpose of each policy and looking at what actually triggers the loss. So was it the service delivered, the system that failed, or the decision that was made? But again, the challenge is if they overlap or do they overlap. So it's definitely getting clear wordings and making sure policies do fit together. That really matters, so that you do try and avoid the blurry lines. And I'm finding a lot of the time with some claims that do come in or notifications that come in, we are actually not just thinking, oh, it's PI, it's we need to notify the D&O as well, or is there the cyber policy going to have to be notified? It's no longer just immediately thinking it's the one policy.
Nick, how about you? How are you doing this distinguishing?
Yeah, I agree with others have said. I sort of come back to sort of the core intent of each product, and sort of keep that in mind as you're drafting a wording and thinking of your target market. What's it intended to do and who's it for? But I tend to think of PI as being intended to respond to claims for an insurer's liability to a third party for the provision of professional services, which I think is fairly straightforward. ML is more concerned with the liability attaching to the mind of the company and how the company operates as an entity rather than the activities of its employees undertaken for clients. And that might include employment practices and social engineering type matters. And cyber is intended to respond to claims arise from the use of a computer system, which may lead to a breach of privacy or confidentiality or denial of service or access matters. Unlike PI, much of the exposure is first party in nature. So I sort of come back to the core intent and who's it for.
Nick, let's stick with you. This question, I guess, is the next stage of the last one. I mean, and there must be times when claims fall into a bit of a gap, I guess, or there's that possibility at least. What are you most worried about in terms of, when a real world claim will fall into a grey area?
I think some difficulties can arise when considering a civil liability PI policy and how it may respond to a cyber-related loss, where the PI policy is silent on cyber. It may be found that a PI policy or tower will respond to a cyber loss arising from a civil cause of action under a PI policy. such as the breach of privacy or confidentiality, regardless of the underwriter's intent. So I think the drafting of the wording needs to deal with that. And ideally, the PI policy should be clear on cyber, and it impose an exclusion or provide an extension such that the cyber exposure is dealt with in an affirmative way.
Austin, what about you? Where are you most worried about gaps?
Yeah, I mean, it's funny Nick mentions that scenario because a cyber PI claim was the exact example that I was intending on providing. So we had a claim a number of years ago now where it was in relation to a bookkeeper, and the bookkeeper had transferred a rather large sum of money to a third party from an email that was not legitimate, and you could review that. And their cyber policy, the wording at the time said that you only had social engineering cover where you'd called to verify the details of the third party. They hadn't done that in this scenario, unfortunately, and it was ultimately covered because they breached their professional duties as a bookkeeper in failing to effectively appropriately manage and disperse the client's money. So that ultimately was a cyber claim that would ordinarily, first instance, I guess, been paid out under the crime section and social engineering section of a cyber policy, whereby it was actually paid out under a PI wording as a result. So, I mean, that's a real world example of how things can get muddy and confusing. And I think something that is, I guess, front of mind is other insurance conditions, whereby insurers will usually only allow you to have rights of claim under a policy where there's no other policies to which you're entitled to receiving those funds. And I guess that's where that original sin scenario comes back into it again. We have to work out, well, what policy was the first domino to fall? What was triggered first? And it can get quite messy when you have multiple insurers involved across different lines of insurance. And that's obviously something that we're not trying to have issues with. And there are some high-risk policies, such as your FIPI policies, which will often combine D&O, cyber, crime, PI into a singular policy or a singular insurance offering, or IT, which obviously includes your professional indemnity and often your cyber. But that's for very specific risk applications. And so we're looking at our industries that might have a higher than usual risk. So accounting and bookkeeping being a good example of a claim that falls across multiple lines, and really trying to place those separate policies with the same insurer where possible, just to make sure that if the claim does arise, we're fairly certain that there's coverage with that insurer. And it's a matter more so for the insurer to work out perhaps which excess applies and where they might wear the loss, as opposed to a scenario where you've got two insurers just trying to palm off cover from one to the other.
I can't help but saying that it's quite appropriate. You're talking about bookkeepers. You've got books behind you. I was going to say they might be DVDs, but that's a bit old school, isn't it? They must be.
That's the personal library. So I like my reading.
Okay, excellent. Genevieve, turning to you in third place there. What's worrying you in terms of possible gaps?
It's clear that it's all is worrying the three of us, and we didn't even meet up beforehand to double check our notes, because it's good old data privacy breaches and PI and cyber. So you just don't know when it is triggering both policies. The insurers may respond differently, or there may be a finger point out on what one, exactly as what Austin was saying, would respond or should be responding. Just on a separate note, an area that is concerning me is that clients I'm finding that are adopting AI and technology-driven services is enabling them to branch out and actually build or create tools that generate outputs for clients. And I'm finding my conversations where there's a common misconception that they think that is just part of their core service offering, and that their PI, their traditional PI in place, is actually going to cover them, forgetting that, a traditional PI is more around their professional advice of services and not products or technology. So it's really having conversations to make it clear, because in an event of a claim, did that actually fall out of your professional services? So you might actually not even be able to trigger your PI policy.
Let's stick with you, Genevieve, and I feel like what you've just said might be part of your answer to this next question. But looking to 2026 and the sort of specific tweaks you may have to do to policies at renewals time, Is there something that you can pick on that you'll be looking at particularly carefully and tweaking compared to early 2025?
Yeah, so I feel like when it was a stabilized market, when it first happened and PI kind of was a bit slow to the table with that and saw it a bit later before DNO and that, I feel like it's not about limits or pricing anymore, but it's actually quality of disclosure and governance. Like the board's getting a lot more involved. There's a lot more accountability, and it's not ticking boxes on your proposal form anymore. AI and data risk are front and center. And whilst it started off as a soft question, I feel like it's becoming louder, and it definitely did as the year went on. And I'm finding that whilst underwriters may not be asking that in their proposals, they're definitely wanting to see the detail. So where is AI being used? What oversight exists, and how is data being managed? So for us, the focus is on disclosure and clarity, making sure clients can clearly explain how AI fits into their business and what governance structures are in place. It's not about creating controls for them, but it's about showing insurers that AI is being responsibly overseen.
Nick, what are you going to be looking at in terms of possibly encouraging a tweak or two in 2026?
There's no one thing, but interestingly, I'm hearing from a number of broker houses now that they're suggesting they expect PI rates to start leveling out during the course of 2026. I mean, brokers and underwriters need to be alert to any change, positive or negative, taking place in the market. And importantly, both brokers and underwriters need to be on the front foot with every renewal to manage expectations, irrespective of how the market may shift. But that's the only way to take clients and insureds with you through the market cycle. The insureds need to understand what factors may be impacting the pricing of their PI insurance, and that a number of those factors are external to their own business and risk profiles.
Austin, you get the last word in 2025. If there's one specific thing you could pick on at renewals time in 2026, I mean, what is it that you'll be fixating on?
Yeah, I mean, it's funny. I don't know if 3 people counts as a trend, but again, there's going to be an echoing of what Genevieve and Nick have both said. And it certainly seems that the trend is really just framing client expectations. And for us, it's really going to be talking to clients early, talking to clients constantly, making sure that they are aware of what's happening and what's going on in the market. And I think as well, obviously, there might be some, I guess, leveling in the market, as Nick's talked about, but certainly the market conditions in the past 12 months have been significantly improved on the prior sort of 4 or 5 years. And it's certainly a time where we're having conversations with our clients around what do you desire? What's a perfect outcome for you here? What's your dream scenario? What do you want to achieve? Because the market has more capacity to provide those things than they did previously. And it's really just drilling in as hard as possible. Let's get the coverage right, and let's put ourselves in a really strong position to continue forward, because as we know, the market is cyclical. We will be in a hard market at some point again. And we just want to make sure that our clients are as well positioned as they possibly can be, have as much cover as possible at the most reasonable possible price, so that we're working from the best position when things do at some point in time, whether that's 1 year from now or 5 years from now. It's just making sure that clients are well protected and well versed. And probably something just as well as from an underwriting standpoint that we've noticed is there's probably still some level of mismatch between how, say, an SME policy might be treated and how a large ASX 200 listed policy might be treated. Now, obviously, they're 2 very different exposures, 2 very different policies, and you wouldn't expect the same underwriters to be working on those two accounts. But certainly we as a brokerage are quite proactive and sort of start our pre-renewal cycle 3 months, if not even further ahead than that. And we're increasingly running into issues where, with the market being a bit softer and there being a lot of capacity, the amount of work you've got to do as a broker is significant. You can't expect to get information 4 weeks out, 2 weeks out, and be able to do a full market reach and get full responses. So we're finding that we increasingly need more time to do our job and to do it well. But then you're mismatched with that from an underwriting standpoint, where insurers are often going, well, it's more than 30 days out, I don't want to quote. Or if they do quote more than 30 days out, their terms are only valid for 30 days, and you can have issues where come renewal, you're going and having to get a bunch of things like NCDs and the like signed, which again, it's just adding to the workload of both brokers and insurers. And it's just working again, framing expectations on both sides and making sure that we manage that to obtain really good outcomes for clients in an efficient and timely manner as well.
Well, thank you. It sounds like the three of you might have to have a short Christmas and New Year's break because of that. But look, thank you very much. Thanks, Austin. Thanks, Genevieve. Thanks, Nick. It's been fun sharing these panels through the year. And thanks out there for watching Insurance Business TV. Bye for now.